which is mistakes, right? Because I know this gets discussed a lot. So I'm just going to talk for a few minutes on this topic, and then we will go about the presentation. We'll start with the Q&A. So how do we define a mistake in investing, right? Like when everybody talks about a mistake, what do we mean by mistake? So we'll say you have lost money in a position, we have missed out a multi-bagger, we were looking at something, a friend recommended something, or we read about something on social media and we did not buy it, or maybe we sold too early or we sold too late. All kinds of timing issues, we'll call that a mistake. But I would like to turn that question around. Let's say you're running a business, right? Let's say you are a retailer, you are a grocer or you're a retailer. uh, how does a retailer behave, or how does a businessman behave? He's not going to complain, or a retailer or a restaurant owner is not going to complain every time, feel down, feel dejected, beat himself or herself up, saying, uh, this particular inventory, I purchased this particular clothing for this particular season, and out of the 100 pieces which I purchased, 95 pieces did not sell at my MRP. What I had to sell it at a discount. What do retailers do, right? They mark down the price. The typical the terminology which is used in retail is called shrinkage, right? So let's say you bought 100 units for 100 rupees and you mark it up for 120 and you sell it. I know I'm giving a very small number, but we'll just live with 100 rupees, right? So I'm selling it for 120 rupees. Knowing from my past history that I I cannot forecast it accurately. I can forecast this plus or minus 90. Sometimes I will buy 100 and the actual demand would be 110. Sometimes I will buy 100 and the demand will be 90. So either I will fall short, or I will have excess and then I have to mark down outside the fashion, or people do not want it and I will sell it for 10 rupees less. Knowing fully well that this happens, I will usually adjust my price for 120. Although my average profit, I want to keep it as 150 or 15 rupees, or I sell it at 150. So what do? You usually look at your past history, and a retailer would adjust their pricing accordingly. So think of yourself as an investor in that terms. I know it's not easy, but in the end of the day, when you make a mistake, it's not about you. Maybe it's an unavoidable part of this active investing thing which we do, right? Uh, you can avoid a mistake 100%, which is what a lot of people from our or previous generation did. What did they do? They just go ahead and invest in a fixed deposit, right? Then there is no, short of putting money into a bank or some place which goes bust, which thankfully does not happen very often. You will never go wrong, right? At least notionally, you will never go wrong. You will always invest it in a fixed deposit, make your 6-7%, whatever it is, and never have to experience failure. Although you're falling behind inflation, and eventually something will inflation catches up with you. So most investors, I would say, spend too much time thinking about their mistake. And I think the best option is, don't agonize over it. Learn from it, keep notes about it, and then move on, because you will make a lot of mistakes. And I think one thing which I can tell you from experience is that they never stop. Mistakes never stop, right? It's not like once after you have invested for 10 years, it's all good, perfect. Now you are a 100% perfect investor. Actually, the only time you're a 100% perfect investor is when you are talking about your investment or when somebody is talking about their investment on social media, or when they're trying to sell something, right? So as long as you keep that in mind, that the best of the investors, 1 minute, let me see. You have to keep in mind that the best of the investors do not get it right more than, let get it right only 60 to 70% of the time, right? Again, keep in mind that this is not a multiple choice exam, right? The big advantage of investing is when you get it wrong, you would have all heard about it, easy to hear and obviously not easy to practice, is that it does not matter how many you get right. It's about how much you make when you get it right versus how much do you lose. The max you can lose if you're not leveraged is 100% of your investment. The max you can make, there is no upside. Now that's where the entire fun of investing is. You can lose 100%, but in another position, if you make three times, you still on your portfolio level, you're still up by a considerable amount. And that is what usually happens. A few winners will account for a good year, for a good, and I will show it with examples at a later point, with a good return over the long run. But at the same time, you have to be very careful. You do not make sort of a fatal kind of a mistake, right? Which will completely knock you off the game. Don't go for leverage. I keep writing it on my Twitter feed, right? Do not have excessive concentration. There is only one Warren Buffett. There was only one Rakesh Jhunjhunwala. All these people forget about the survivorship bias, which means we only see those investors who are successful. Those who went bust are no longer visible. They are not talking about themselves on social media. They've long left the market, right? So you only see successful investors. How many times have we seen somebody who's on social media and keeps talking about all the money which they are losing, right? That never happens. So even excess concentration, unless you have demonstrated proof to yourself, right? I'm not talking of trying to prove it to anyone. You have proved that your batting average or your average of your success rate is so high that you can go for for excess concentration. And what do I mean by excess concentration? A couple of positions, 4 or 5 positions. That is quite high concentration. Sometimes even lesser than that. So the most important thing is you have to build. You should know what is your success rate, and then you build it into your portfolio construction, into your strategy, and we can dive a little bit deeper into that also later. Let's the next slide on this one. Let's see.